Hello, everyone. Today on the final bar, we will break down this Monday activity. Kind of a choppy session for stocks, but a lot of key names in the moves. We'll talk about names like Alphabet rotating lower, AT&T rotating lower. Strong areas of the market as well, industrials in particularly, having a lot of names, airlines, heavy construction, and others pushing onward to the upside. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets using the best practices of technical analysis. The Technical Analysis Toolkit is really designed to help you understand what's happening by focusing on the movements of the markets themselves, right? How are stocks and ETFs, industries, sectors, other asset classes like commodities and currencies, all of them can be understood or really better analyzed through the language of charting and technical analysis. We hope to just touch on some of the key themes that we see as we break down the activity in the markets, focus on what happened today versus the longer term trend. We'll see big moves in areas like Bitcoin, Ethereum, ripping to the upside because we had a bank put out a pretty aggressive upside target. We'll get to all those charts and a lot more here as we enter our market recap. Do want to remind you, we always have a poll going on our social media accounts, so make sure you follow us on Twitter and elsewhere, and especially on YouTube. Subscribe to our channel. You won't miss the next one. We asked you recently which technical indicator would be considered a trailing stop indicator. This is more of a technical analysis quiz. Final Bar Nation, I want more from you, all right? RSI, incorrect answer. It's almost a tie for RSI and parabolic systems. Parabolic systems is indeed a lagging indicator. It's similar to things like the chandelier exit, which you've seen doing like an exponential moving average as a trailing stop. Parabolic systems is a more dynamic way to try to do that sort of trend following technique. All of these indicators, RSI, DMI, ADX, the average directional movement, which is derived from DMI, and parabolic systems, all created by the same man, Wells Wilder, unfortunately no longer with us, but he wrote an incredibly meaningful work in the technical library called New Concepts in Technical Trading Systems, I think from the early 1970s. It's a really cool book because you literally see his old accounting ledger where he hand calculates each of those. And part of my early learning experience, my learning curve as a budding technical analyst was to prove out all indicators like this in Excel. And that's how I learned how they were all calculated. I would not want to do it again, but I'm thankful that I did a long time ago. Parabolic systems is one of those great indicators to have on as things are going well, because at some point, as we'll see from the chart of Alphabet here in a few moments, uptrends turn into swings to the downside, right? You have a pullback phase. Something like parabolic systems is designed to help you lock in gains, but recognize when the trend has shifted. If you have questions on any of those indicators, by the way, our chart school portion of our website, totally free, has a lot of fantastic educational material on different technical indicators like those. Having said that, let's look at how the markets played out through the course of the day today. I mentioned sort of a choppy session more than anything. If you look, the S&P 500 still closing above 4,400, just below 4,410. That's up about 0.25%. So really, Friday kind of finished right at 4,400. We moved a little bit to the upside, but overall, sort of a choppy sideways, unchanged kind of feel to the tape today. The Nasdaq Composite about the same, 0.2% higher. The Dow leading the way higher, up 0.6%. But I draw your attention to mid caps and especially small caps. The S&P 600 small cap index actually up 1.3%, pushing above 1,200. Sort of got down to that 1,200 level on Friday's close. Nice move. One of the challenges I think of the markets, the bull market thesis in 2023 has been a lack of participation in small caps, and we've talked about that in terms of the relative performance. We've talked about the breadth characteristics in small caps, a lot weaker than in large caps. So I would argue that further improvement from here most likely has to include participation from small caps. You're actually seeing them bounce higher. Right now, it's more because of the sector weighting. So in the mid cap and small cap indexes, you have a little more like healthcare, industrials, energy, especially financials. And I just listed out the 4 top performing sectors today. That's why small caps are outperforming just fine. The S&P 100 mega cap index actually went in the red going into the close. Volatility going to the upside. So the VIX back above 15. And again, 15 is an outrageously high number if you compare the VIX of the last month If you compare the VIX to the last decade, 15, or last couple years, 15 incredibly low, to the last decade, 15 kind of in the middle. So it's all about what sort of frame of reference you use for here. But based on this recent move of a slow and steady bull market on lower volatility, we're starting to see more and more signs of that volatility picture starting to change. The VIX pushing back above 13, back above 14, now 15 is pretty meaningful. I would also bucket high yield spreads in there starting to widen. All of those things tell me that the conditions, the character of the market, certainly seeming to change here. Speaking of interest rates and other asset classes, let's look at the fixed income markets. Always an interesting relationship between stocks and bonds. A lot of people think from an asset allocation perspective, that 60-40 relationship of 60% equities, 40% bonds, that's come under a lot of fire in recent years because it hasn't been a particularly successful strategy, mainly because bonds have not been the defensive play that they have been in previous cycles, right? When stocks aren't working, bonds aren't particularly good either. And so the relative performance has been stocks over bonds pretty much consistently over the last 3 to 5 years. Right now, you're seeing rates come off a little bit at the 5-year and 10-year points. The 10-year yield is just above 4%. That was sort of that high water mark over the last 12 months. You got up to around 4.25, 4.25. We bounced back down below 4%, down about 3.25. Now pushing back. We're now at the upper end of where we've been for the 10-year for the last couple of years. So pulling back a little bit today, but I think the larger theme has been this falling bond prices, rising yield sort of environment. The 5-year yield pulled back, but still around 4.25, and the long bond yield remaining above 4% as well. Dollar down about 0.25% using the UUP, so not a huge disruptive day at all. A lot of again, relatively low movements in the commodity space. The DBC commodity ETF was up about 0.2%. Gold essentially flat for the day. Silver up about 0.3%. Copper 0.4%. So not huge changes overall. And crude oil prices came off a bit, although the energy sector had a pretty decent day to the upside. Speaking of huge moves to the upside, we had all it takes is a headline, and this is what we've talked about with cryptocurrencies. It is a volatile, noisy asset class, and again, relatively new compared to a lot of the other ones we talk about, but still just a lot of volatility. We had a big volatility injection just earlier today. Standard Chartered Bank, which is a UK-based financial institution, upgraded their target for the end of not this year, but next year, end of 2024. I think their target before was $100,000. Now it's up to $120,000 for Bitcoin. Obviously well above 30,000, and that's why you're getting a bit of a bounce to the upside. That's that sort of spike that you see on the little chart here. And again, this is the challenge. This is the upside potential on something like Bitcoin. If we start talking about aggressive upside targets like 100,000 plus, which would be new all-time highs and much more, that certainly suggests that there's upside potential from current levels, right? And even though that target is down the road quite a bit, shows that there's optimism about where things could go from here. The challenge is one negative headline, one headline about a regulator getting a little more aggressive, people wanting to tampen down the decentralized nature of a decentralized thing like Bitcoin or Ethereum, and it immediately can go down lower. But for today, it's a nice move to the upside. From a technical perspective, we'll look at a chart of Bitcoin here in a minute. We'll look at what today's move means more likely to the bigger picture. In terms of sectors, industrials number one. I'm thinking back to my conversation with Marianne Bartels last week. We talked a little bit about industrials. That was one of the areas she was focused on. I think that makes a ton of sense. We'll show you some of the names that are working within the industrial sector. Some of the top-ranked scooter names are in the industrial sector, about 10 to 12 in the industrial sector, ranking in the top decile of our large cap scooter rankings. After that, healthcare, 0.8% higher. Energy, also just about 0.8%. On the downside, you had a couple sectors down on the day. Utilities, communication services, both down about 0.25% to 0.4%. Materials and consumer staples, unchanged. Let's go to a chart of the S&P 500, see how today's move fits into the big picture. Again, I think we're still sort of in this environment where we have a market that has had an incredible run to the upside, no doubt. We're getting a lot of these bearish momentum divergences. We've mentioned these on the show before, and I'll just point out, if you go to StockCharts.com and go to the articles page, article I posted on Friday called 3 Key Charts Showing Bearish Divergences. Talked about Amazon, Lam Research, LRCX, and also the S&P 500. And the reason why the S&P 500 I think is such an important one is this is what happened to the S&P 500 in 2021. At the end of that bullish phase, you have this bearish momentum divergence. Ended up making a briefer higher high at the end of the year, beginning of January of 2022, and then, of course, quite a bit of deterioration. So a lot of similarities right now with sort of the fourth quarter of 2021, the end stage of that low volatility 2021 rally. Go to that article, by the way, on our articles page if you want to learn more about some of those divergences and what that means. But this is the bearish divergences I would notate on the S&P 500. This does not happen often, by the way, and I'm seeing this sign pop up here. So that sort of plays into the general thesis I'm operating on, which is the uptrend is near an exhaustion point. We're starting to see rotation in different parts of the market. We're seeing divergences in some of the major benchmarks, and now you're just waiting to see if we break down to the downside. For me, 4,300, that's that line in the sand. As long as we hold that, this is still an uptrend, right? By any sort of general definition I would use. We start to fail to hold a level like 4,300. That would put a lower low. That would tell us we're unable to hold support, and that would lead me to start thinking about further downside targets. That's what we'll talk about, Fibonacci retracements and trend lines and all the levels that you may want to anticipate further downside as sort of a downside objective in a pullback. But first things first, as long as we hold 4,300, by my read, I think this is still a decent uptrend to the market. Let's look at the chart of Bitcoin here. As I mentioned, right, a nice move to the upside. That's sort of an active move. We're still sort of playing out right now. What's interesting is it's pushing Bitcoin, again, right off of that 30,000 level. I've often talked in the cryptocurrency space, big round numbers tend to be meaningful. If you look back at the chart of Bitcoin and look at every time we hit 30,000, 40,000, 50,000, 10,000, 20,000, meaningful things tend to happen. I don't think that's a mistake. I think that is the nature of markets like this and humans focusing in on big round numbers as an opportunity to reassess where things are at. So I'm not super surprised that we keep bouncing off of 30,000. Today, again, we're moving above there. I think getting above 31,000, making a new high for the year, obviously pretty important, sort of validates that uptrend potential. And what's interesting is we've been sort of rallying from here, but chopping around. This is sort of a basing pattern that goes back to March, April of this year, which is when we first reached 30,000, then had this big retracement. Now we're back up to the top, testing support at that same level, potentially rotating higher. So I think this is really close to a significant breakout to the upside. And again, the momentum remaining pretty positive, which is encouraging as well. The XLI, another move to the upside, making a new 52-week high today with a strong close. And again, what's interesting is this is a market or a sector that was basing. So while the S&P sort of pushing higher at times, you can see the industrial sector underperforming through the end of May. June was a big turn. You had this gap higher and a bit of foreshadowing to our Q&A segment, the mailbag. This is what I'd call a breakaway gap, sort of that initial gap off of out of a basing pattern, really followed through to the upside. Sort of a nice move above moving average support. Now we're just making higher highs and higher lows. If you're trying to understand that sector a little more deeply, what I would do is point you to the scan engine. I run a simple scan for the scooter ranking above 90, and I like to put in a group or a sector. Here I'm looking at the industrial sector and showing me all stocks with a market cap above 10 billion and a scooter ranking above 90, which means it's in the top 10% of large cap stocks. Here's the list of names that was returned when I ran this about 15 minutes ago, and you can see it's things airlines, right? American, Delta, United, all popping up here. Builder's First Source, BLDR, which was at times been the top ranked stock in the entire large cap space, now down to the 98th percentile, still pretty strong. You'll see GE, FedEx, some of the names we've been highlighting recently, WW Grainger, an industrial supplier. So looking for stocks in a strong sector and focusing on the ones leading the way higher often can be a really interesting way to identify leadership names in strong groups. I'm thinking back to Bill O'Neill talking about strong stocks and strong sectors. This is one of the ways I would use this StockCharts platform to try and key in on those names. Now, I would never just blanket say these are the stocks you obviously want to buy for any reason. I would say this is a good working list to start to analyze and think about what sort of entry and exit points you may want to consider for a thing like that. To wrap up our market recap, let's look at Alphabet. I have to highlight a mega cap name breaking down below the 50-day moving average. Last week, we talked about this bearish divergence. This was one of the first names actually showing this bearish momentum divergence. Mid-May to early June, higher prices. Mid-May to early June, lower momentum, lower RSI. We pulled back, I would say, as expected, to the 50-day moving average. Today, Not a great signal because this is now failing to hold the 50-day moving average. I think that could be the sign of this further deterioration. Maybe Alphabet is the beginning of this, of the mega cap names sort of leading the way down, and others start to follow it. So those first responder types of names coming down initially, I think, are happening here. The RSI at the end of the day was just barely below 40, kind of bounced up just a bit going into the close. But I think this could be an important name to watch to see if we get follow through tomorrow through the course of this week. Do we get further follow through to the downside? I also want to highlight AT&T, and this is more of a short-term discussion, but one of the things I love about charting is how different things like moving averages, like patterns, they tend to just come back more and more, right? And support and resistance levels, it's not about reading about them in a book and then hoping you see them someday. Just in the last month, look at how AT&T has bounced up against resistance. This is just above $16, around 16 and a quarter, we'll call it. Bounced up there first in mid-June. This is coming off of a new swing low after the drop, the gap lower in April and the move further to the downside. You then have a rally up to the same level here in the second week in June, and then once again we test that level. So there's a reason why, if you look at a lot of my charts, I have those horizontal lines identifying key levels, because more often than not, you find this sort of scenario you like to do with AT&T. Once you identify a resistance level and we sell off, it's always important to note where we're at relative to those previous highs and lows. That is one of the reasons why this show is called The Final Bar, because I always talk about where we're at right now. Look to the left and find those days that are sticking above, right? Potential resistance, potential support around the current price level. That served you really well here right around the 4th of July holiday as we once again tested that level of just above $16. Failed to get above the 50-day moving average, as you see here in blue, and rotating back to the downside. Now, it's not all bad. And the last chart I'll show you, charts like DraftKings just keep working. What's interesting about a chart like DKNG, like others as well, the move today up over 8% is just the latest in a trend that's happened over time. So when we talk about wearing your trend follower cap, and we talk about stocks and trends and following them, the chart of DraftKings is one of those that comes to mind. The momentum overall has remained fairly strong, with the RSI rarely dipping even below 50. We've remained above the 50-day moving average since breaking above it in January. And overall, higher highs, higher lows continuing. That is a chart in an uptrend that continues to be in an uptrend. That's our market recap for today, hitting on some of the key charts and technical patterns that we want to highlight. A couple quick announcements before we open up the Final Bar mailbag. First off, we love hearing from you. We love your questions. We certainly appreciate your feedback, but your questions are most important because it helps us think about what sort of questions we can address on our show. thefinalbar@stockcharts.com is the best way to get a hold of us. That's our email. On Twitter, just tag us in a comment @FinalBarSCTV. And if you're watching this on YouTube, just put a comment right below the video that you're watching. We'd love to hear your comments there, and we'll capture all of those and hope to answer your question on our next mailbag segment later this week. Also, just so you know, we have a little pretty big deal special happening right now at StockCharts. If you go to StockCharts.com/special, you will find that we're doing a super sudden summer sale. It is just for a limited time here. You can actually lock in free months. If you've thought about becoming a premium member at StockCharts at the basic, extra, pro levels, this is a really good time to do it because it's the best price you're going to see for quite some time. If you are a current member, you can extend your membership by going to StockCharts.com/special and lock in the deal today. So I would encourage you to go check that out and take a look. Also, just so you guys know, I think that's it. Let's go to the mailbag, shall we? Again, thanks again for all of your great questions. We so appreciate it. And let's get to question number one. Dave, on the chart of AMD, is the gap a good price target for a pullback? And I really appreciate that question. AMD is one of the names we highlighted as one of those first ones. I talked about Alphabet May into June, giving that bearish momentum divergence. You're getting the same sort of pattern here on AMD. You have late May into early June, higher highs in price, lower peaks in momentum. Now we're getting the pullback that I think makes sense. That's the sort of thing that I would expect after the bearish momentum divergence, which is why when I'm seeing this exact same pattern happening on the S&P now, I'm thinking, all right, maybe this is the pullback, and maybe charts like AMD and Alphabet are sort of giving us a preview of what our major benchmarks are going to be doing. It's an open question. For now, though, bouncing off of the 50-day moving average and rotating lower. And your question is, this price gap right here, is that a good gap to use, and you had a much deeper question. You asked a lot about different gaps. Should you expect gaps to fill? What's sort of the general way to do it? So you implied in your question the different types of gaps, and I think that's important to remember. There's generally 3 types of gaps that you want to think about. There's one called a breakaway gap. I mentioned that on the chart of the industrial sector, the XLI. You could probably consider this one here. I would consider this a breakaway gap because you have this sort of consolidation phase for AMD. We're testing resistance, and then we gap higher. And that's a breakaway gap, meaning you're breaking out of an established level, whether coming off of a new low, or you're in a basing pattern, and then you have this initiation move, what you might call an impulse move if you're an Elliottian. And so that impulse move with a gap right at the beginning is called a breakaway gap. It happens very early on in the trend, initiates a new wave of buyers, really excited, buying up a lot, pushing the price higher, and that usually means a lot further upside. At the end of the move, and I would argue this may be what we're seeing here, you have what's called an exhaustion gap. This is after an established trend has happened. You get this gap higher, and often it'll happen around like an earnings release or some sort of news flow, and there's this big gap higher. But because there's already been this run, and everyone that's been buying on the way up is now just sitting on a great paper profit, it ends up being a really good opportunity for people to take those profits. That selling pressure will often cause the price to go right back down. So that's called an exhaustion gap. There's a third type of gap, which you don't really see here, I don't think, called a continuation gap, which often happens in the middle of the move, sort of in the middle of it. It's hard to tell, to be honest with you, the difference between a continuation gap and an exhaustion gap. That's where I would argue that using other tools in the technical toolkit can be really helpful. In terms of what you do here, I think more often than not, breakaway gaps, you usually don't expect those to be filled, or at least I don't. This one actually did. You see we gapped higher, we came back, and the gap actually served as support before we rotated higher. You can see this sort of thing happened here. We gapped higher, we pulled back to the upper end of the gap. We've now filled the gap and gone below that level. And I think now that we're sort of testing resistance at the upper end of the gap, this gap level now sort of serves as a resistance level. The way that I would tend to think of it, just to simplify everything I just said, I tend to think of it as a big support and resistance range. Anytime I see a gap, that's a really good time to put sort of a range, a little rectangle on here. I'll get to that because there's another question about this in particular, so I'll show you that in a moment. But I found more often than not, those gaps are key support and resistance levels going forward. So I keep that in mind anytime you see a gap. And that's why you often hear about gaps being filled, because what happened with AMD often happens where stocks will pull back to a key price gap as support or resistance. Great question, and thanks for that. Question number 2, using Elder's impulse system on XME and getting stopped out. What did I do wrong? There's a lot to unpack in this. I only have a couple minutes to address this great question. Yet again, a longer question. We asked it a lot about the Elder impulse system and just different combinations and what to do. I will tell you right now, we don't have time to go too deeply into the Elder impulse system, but it's basically a color-coded system for price bars. It was popularized by Alexander Elder in his book, Come Into My Trading Room, I believe, where he talks about this. And long story short, green are kind of impulse moves to the upside. And if I remember, it's the slope of like the 13-day EMA and the MACD histogram going up. And if both of those things happen, it's shaded in green. If the opposite, if the moving average is sloping downwards and the MACD histogram is going down, then it's a red impulse move to the downside. Blue is basically a neutral. So you're looking for green days as a breakout day to the upside, red days as a breakout day to the downside. And you'll find that a lot, right? We have this down move, you have a neutral day and then a green up day, we move higher. Then we have a blue neutral day, a red day, which basically tells you we go lower. And often it's really good for swings. I don't use the Elder impulse system a lot. I think for swing trading, it is a fantastic way of visualizing data. And I think the fact that it uses a regular price bar, but just uses the color-coded bars, I think is a really powerful way of incorporating that system into a chart where you already have other things. So I think you're asking the question about this impulse move to the upside. I think that's a really sound approach. Now, in your question, you basically said you're getting stopped out because you sort of traded down and hit the parabolic studies. So what did you do wrong? I would remind you that just because you hit a stop, a lot of times the initial reaction is, oh, that was wrong. Oh, that didn't work. Now what do I do? I would argue when you get stopped out, that means it worked. That means you have a money management process that actually played out. That means it kept you from the potential of a really bad loss. Remember, all large losses begin as small losses. So just because a stop is triggered, just because a particular signal doesn't play out as you would ideally want, don't think that your system is broken. any sort of trading system is not going to be 100%. It's often going to be well below that. It can even have a hit rate below 50%, meaning less than chance. As long as you have a good money management strategy, you can actually make quite a bit of money from that sort of system. So I think the way that you're lining these up using the impulse system and parabolic studies is a great way to identify potential breakouts, but also lock in and minimize any downside protection. I think that's actually a really powerful combination right there. Next question. How do you draw support and resistance levels as ranges instead of lines? When I was on this previous chart, I was thinking, I think it was on AMD, how do you sort of recognize that this is a range and not a level? And you'll pick that up on a lot of the charts that I share, like on the chart of the S&P 500. I have these shaded areas that I always talk about. I have some lines on there too, but the really important stuff are shaded areas. This is an Arthur Hill trick, and he taught me this a long time ago as I was trying to get comfortable with the StockCharts platform and just thinking of different ways to use the annotation tools. He would publish charts like this. Instead of drawing a line, right? So instead of saying, here's a line right here. And by the way, StockCharts 101 on the Mac, you hold the Command key. And I think on a PC, it's like the Alt key or something like their Option or one of those other ones. If you draw a line and hold down the Command key, it makes it perfectly horizontal or perfectly vertical. That's a great sort of cheat sheet way to do that. So instead of drawing that to identify the gaps, what I would do is this. I would draw a rectangle like this. And then you can actually use the shading and just draw it down like that. See, that makes that kind of nice pink shaded area. You can do some other things in terms of the fill and all these other sort of tools, the line width, to make it look different ways. But I have found for support and resistance levels, making them more like ranges as opposed to particular levels, way more recognizing, I think, the reality of trend and support and resistance levels in 2023. I feel there's a lot of wiggle room when we're trading at sub-decimal, sub-pennies with different stocks and ETFs, thinking that something will hit an exact level precisely and then turn. That's a joke, I think, in 2023. Recognizing that there are areas or zones of support and resistance makes way more sense to me. I think that's recognizing the current market structure and what is a much more reasonable way of doing it. So, above the zone is bullish. In the zone, you're at that level, and breaking through the zone is when things start to get ugly. So that's how you kind of do it. And what's great is they save just like trend lines. You can, put them in different ways. And that's why the chart of the S&P that I often have, uses these shaded areas, and I'll tweak them occasionally when I see some big move. But a lot of these shaded areas, I set them months and months ago, and I just always have them on the chart so I can recognize if we would rotate lower. These are some of the levels that have been important to me previously. And part of my analytical process is updating these lines, updating these levels, thinking about how the structure is changing, new patterns, new movements, new gaps, and how that might inform where we might find potential support and resistance going forward. So that is how you draw them as ranges instead of lines. I think this is a really powerful way of using the StockCharts platform to identify support and resistance zones. Next question. PPG is trending down on the RRG chart, but strong price action over the last 4 weeks. What gives? Again, this is a great question. Julius de Kempener, of course, created the RRG. He's the authority. I'm a longtime user of the RRG and a huge fan of Julius and his work, which is why I'm pretty happy answering your question. So, having not known exactly what you're talking about, I think you said this. PPG is trending down on the RRG. I'm wondering if you're looking at the daily RRG. No, I don't think so. So I would guess you're looking at the weekly RRG like this. I'm doing the max, and so I think what you're talking about is this, right? You can see that the RRG, as I rewind over the last 6 weeks or so, you can see we were in the leading quadrant heading straight down and now continue to push lower. And your point, if we look at the chart of PPG, you were saying, yeah, so the price is actually going up. How can the RRG be going down? So a couple thoughts on this, right? So number one, what you have to remember is the relative rotation graph is all based on relative strength, right? And I don't mean the RSI, I mean the series that I put at the bottom of all my charts, which is looking at the relative performance of the stock or ETF versus the S&P. That is drawn on the RRG. This is the benchmark you put right here. So you could put some other benchmark and it'll do it relative to that. But you're usually doing the relative rotation graph. The whole idea is to look at a group of things relative to a benchmark. And it was really designed initially for institutional investors. That's how we used it. You have a portfolio benchmarked against the S&P 500. Let's look at the stocks that we own and see how they're rotating and see what's working and what isn't, and focus on things that we hold that are starting to underperform, things that we don't hold in our benchmark that are starting to improve. And I still to this day use it for that sort of rotational work. And we often talk about it in the context of the 11 S&P sectors, but you could do it on any groups of stocks. And under the groups drop down, there's actually a bunch of different things that you can do, including members of particular sectors. Now, you can also type in tickers, and here's what's happening. So what you also have to remember is this is all based on relative strength, so not on absolute price movement. So if the price is going up, it's less about that. It's more about the relative strength and how the relative strength line is trending over time. What happens is when something's in the leading quadrant and the line is going to the northeast, so it probably happened back here somewhere, yeah, like here, that means that the stock is outperforming, the relative strength is sloping up, and the pace of it is improving. And that's why you're going further to the right, which means you're outperforming. And then the vertical axis is the momentum. If we're still outperforming, but the momentum is slowing down, then we do this, where we kind of still are to the right, which means it's outperforming. It's just the momentum, the pace of that outperformance is slowing down. So PPG being down here and trending down means it's still outperforming the benchmark using this this data series, but the pace, the rate of that relative outperformance is slowing down. And that's why we often talk about things on the right side are usually stronger areas of the market. Things on the left side are weaker areas because the distance from that y-axis is really telling you the strength and weakness of the relative performance. The vertical axis, the x-axis, or excuse me, the y-axis is really telling you more about the momentum or the rate of change, a second derivative of that relative performance. That was a tough question to answer. I hope that makes sense and you get a sense of why the PPG stock is doing that on the relative rotation graph now. Folks, we've got to wrap the show and go to the 3 in 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Shout out to Jordan Ewell at Stonecastle Investment Management in Toronto. Jordan and I were chatting over email, and he shared a chart kind of like this. I adapted it a little bit to show on the air today, but I just wanted to highlight the fact that mega caps outperforming has been the story in 2023. Certainly one of the main stories, and it sort of plays into that growth trade and all of that. You're seeing a nice move to the upside until the end of May, the month of June, and now into the beginning of July. You're seeing that relative strength go down. Think about the chart of Alphabet breaking down through the 50-day moving average. This ratio of the Vanguard Mega Cap ETF, ticker MGC, breaking down through the S&P 500 or relative to the S&P 500, that ratio breaking down through its 50-day moving average for the first time since the first quarter. This, I think, is one of those many signals that we're seeing indicating a potential rotation. The other side of this was that do we see a performance or an outperformance in small cap stocks? Here we're looking at the the Russell 2000 IWM versus the SPY. Not really rotating too much, but just maybe starting to bounce a little bit. I think the one of the thesis, I think one of the outlooks that makes a lot of sense to me, given the divergences we've seen in some of those leadership growth names, is if we see a rotation lower in mega cap, a rotation more into small caps. Our benchmarks are going to suffer in that environment, generally speaking, because they're really tied to these mega cap growth stocks that dominate an ETF like the MGC. So thanks, Jordan, for that chart. Great take. And I would agree with you. I think this rotation lower in mega caps is key. Chart number 2, offense versus defense, thinking about how the picture has changed. While we're seeing a lot of these divergences, and again, I highlighted my article recently focusing on a lot of those bearish divergences, including on the S&P. One of the sort of ways you validate the rotation in the markets is to see a change in leadership, right? See a rotation from offense to defense or defense to offense. My favorite way, as we've often shared on the show, is looking at the ratio of consumer discretionary versus consumer staples. I was talking to our StockCharts interns. We have some interns in the shop over the summer. I was talking to them on Friday, just giving them sort of a primer on how we use different technical tools. And we talked a lot about things you want versus things you need, right? Discretionary purchases, you don't need to make them, but they're things that you do when conditions are optimal for that, right? When conditions are good, when you have money to spend, you go buy a new car, new clothes, new whatever luxury good you want to fill in the blank with. No matter what is happening in the world around you, you still need household goods and personal products tobacco, and all of those sorts of things. And so as a result, this ratio is a great illustration of things you want, offense, versus things you need, defense. This ratio is still going up. So even though mega caps rotating lower, even though growth stocks like Alphabet rotating lower, we're still not seeing a big rotation into defense. So I'm still reading this as the market more offensively positioned. If and when this rotates lower, that might be one of those big check marks to make on a bull market top checklist. For now, still saying offense over defense. Final chart, FTNT, Fortinet. This is a software stock. I'm sure you're familiar with it. It's been a strong name in 2023, along with many other technology stocks in many of the groups within the sector. All I would tell you is, again, I often talk about sort of putting your trend follower hat on. And when you have a stock that is making new highs, like FTNT is doing this week, making a new 52-week high, pushing above the December 2021 all-time high, I'm inclined to follow that trend. And there are different ways you can follow that trend. Parabolic systems, which is one of the questions we had posed in our poll recently. It could be something like the chandelier exit, or a 50-day moving average like we illustrated earlier in the show, or it could be a simple trend line connecting the lows, and as long as we hold above trend line support, any sort of pullback is not getting that bad. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Don't forget to go to StockCharts.com/special. It is a really good time to think about a premium membership at StockCharts. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow.